The paper started with a question that exchanges ask, which is, what is driving IPOs in the market? What is bringing firms to list? What's stopping them to list? We have seen in some jurisdictions the listing process has decreased. In other jurisdictions, it's been very strong. So understanding what is driving this variability was a very important question for us to understand.
Why does GDP growth matter to IPO activity?
Liquidity is the guarantee that a firm that wants to list, that when they list, they will find themselves with a sufficient number of buyers and investors interested in the firm, able to trade the shares of the firm, and therefore the price discovery process will be efficient. And from the side of investors also, having the confidence that the market is liquid, so they can enter and leave positions with minimum cost, is also important for them to support the listing of a firm. So liquidity is a critical factor when firms are thinking about listing. It's like the oil in the machine. We were expecting precisely that type of result, that the IPOs tend to be more intense, the process of IPO listing, when there is more liquidity in the market. With regards to the GDP, I think it's also relatively straightforward to understand how this channel operates. So when you have a strong GDP, so that's an economy that's growing, you can find that firms are in a better position to decide to go into an IPO process. They may have a better financial position, a more confident view of the economy in general, and less uncertainty in the future valuations, and less uncertainty on the whatever sector they are operating, on the evolution of that sector. So the prospects of future profits are more robust, and therefore the decision to list may be more well supported. And that's what the numbers have shown in the analysis that we have produced.
How do deeper financial systems change IPO size versus IPO frequency?
When you think about the frequency of IPOs, it means that we're looking at, the decision perhaps of smaller companies to go into the market. So these smaller companies may be SMEs, for example, small and medium enterprises that decide to go. What allows them, or what motivates it or drives them to go into the market is very different from large companies. A large company would require, or would be expecting, much more liquidity in the market in order to absorb a larger IPO corresponding to the size of the company. Whereas smaller firms may be more interested in finding the right time to list, and they probably do not require larger pools of liquidity to, depending on the sector, to take the decision to list. So what we see here is that if you have a deep financial system where the pool of liquidity is deep enough for large companies to take the decision, you see those companies coming into the market. So that will show in the IPO sizes that we observe. Whether the frequency is more about not only the large, but also smaller companies that are looking more for the timing of decision to go for a listing, rather than the need of waiting for a large pool of liquidity to be there.
Why do advanced and emerging markets respond differently to volatility and reforms?
In this paper, we split the countries into economy level, try to understand, is there any difference between emerging and domestic economies. So we find a difference actually across the level of development, and IPO activity in emerging and developing markets responds much more strongly to changes in liquidity, financial development, and economic growth compared to advanced economies. So this reflects the fact that actually the emerging markets may be starting from a lower baseline. So improvement in the market condition can disproportionately have a large impact. So when liquidity improves and growth accelerates, the IPO pipelines in these markets responds quickly, and in advanced economies where the markets are already deep and mature, similar changes have smaller marginal effects. So this actually highlights why the policy reforms and market building efforts can be especially powerful in emerging markets, and improving in liquidity financial development, and regulatory design can unlock the IPO activity relatively quickly. When you compare to the advanced economies, which is supporting the firm growth and capital formation.
What does the Listing Stringency Index reveal about listing standards and IPOs?
We need to explain what is the Listing Stringency Index. So this is any index which is a survey-based composite measure developed using data collected from WFE members. And it mainly quantifies and compares the IPO listing requirements across 9 different regulatory dimensions, such as financial, corporate governance, disclosure, voting rights, operational requirements, regulatory approvals, IPO fees, share distribution rules, and tax incentives. So we try to cover different dimensions of listing requirements. The key idea is the LSI provides actually a standard way to compare how strict or comprehensive listing regimes across the jurisdiction without prescribing what is the right level of regulation should be. So this index is just telling us actually it's a benchmarking and comparative insights that supporting from the policy dialogue. So when we look the LSI index, we can see the differences between across jurisdictions. So the exchanges in advanced economies show relatively narrow range of LSI scores, which indicating more harmonized and I will say consistently moderate to stringent listing framework. But on the other hand, when you look at the emerging markets, it display much more a bigger variation, which is reflecting the difference in institutional maturity and policy priorities and market structure. How this LSI relate to IPO activity? If you come to the main finding about the relationship between LSI and IPO activity, we have 2 different analyses, and one of them is the cross-exchange comparison. As you mentioned, we find that the higher LSI scores are associated with larger IPOs, but not necessarily with a higher number of IPOs. This suggests that actually more extensive listing requirements may act as a signal of firm quality and investor protection, or simply reflect a selection effect where only larger firms can satisfy to meet with these high standards. But when we look at the changes in listing requirement within the individual exchange over time, we find that the results are very clear. They clearly say that when exchanges relax listing requirements, the IPO activity increased significantly, both in terms of the number of the listings and capital raised. So lower entry barriers encourage broader participation.
Which listing rule changes boost IPOs without hurting investor protection?
Of course, when we talk about changing or relaxing some listing requirements, we always have to bear in mind that there's a limit to that, which is the investor protection should be the priority. But having said that, there are listing requirements which, depending on the market, may be withholding some firms to list, and that could be relaxed without affecting the protection of investors. It depends also a lot on to which type of firms these requirements apply. So, for example, there are places where there's a threshold on the size of the firm, and depending on the size on that threshold, the requirements change. That applies in the case of markets where they have a specific segment for SMEs, where this segment is subject to a different set of requirements. So this has proved a very successful way of encouraging SMEs to list, which we know small firms have different sets of needs and conditions, and therefore have to be treated in a different way. So I would say that one of the successful ways of addressing this problem is precisely what many exchanges do in establishing a specific alternative segment where the level of disclosure may be reduced, the level of reporting may be reduced, and also the investors are aware of that. So there's a clear understanding for an investor that they're putting their money in firms which are smaller, the risk is smaller, and therefore also the listing requirements are according proportionately to the size of the firm. So I would say that one of the most successful strategies in addressing the question of listing requirements is precisely to creating an alternative market which is tailored to the needs of the SMEs in the country.
What did the pandemic IPO surge teach you about temporary support versus fundamentals?
When you look at 2021, there is the IPO market is making a peak. So it was nearly about 2,700 IPOs raised about more than 500 billion US dollar globally. And then after that period in 2023, we can see a sharp contraction. Actually, we end up with just about 1,200 IPOs and about 120 billion proceeds by 2023, which reflecting the tighter financial conditions and rising geopolitical tensions. So in pandemic, the IPO boom shows that the IPO activity can surge temporarily without any fundamental change in market structure. During the COVID recovery, the IPOs increased sharply as a result of exceptional conditions like ultra low interest rates, large fiscal and monetary supports, abundant liquidity, and unusually strong investor risk appetite. So the many firms also brought forward listing that had been delayed during the initial uncertainty. We also, in our paper, we show that uncertainty is affecting the number of IPOs, which is postponing the IPO decision. However, this surge proved short-lived. So once financial conditions tightened and uncertainty returned back, the IPO activity fell back quickly, especially in the markets with the weaker liquidity and institutional debt.
How can exchanges improve liquidity so that more SMEs list?
One important thing is to identify the needs of the SMEs and create a market that is tailored to those conditions. One thing that is important, for example, is the tax. Tax is an important component in the decisions of investors and firms. Also, financial literacy. Some of the examples that we have seen of very successful SME markets show that the liquidity is closely related to the country's, financial culture. I always like to think about the example of the Swedish markets, Nordic markets in general, but in particular, Sweden is a country where there's a very successful SME market where companies, even small companies very small companies are coming to the markets to fund themselves. Understanding that the capital markets offer the possibility of funding in a more efficient way, without being dependent on bank credit or the other source of funding, it's an important element. And this is linked to the financial literacy of the country, of the tradition of investing in the markets. So this is something that the exchanges, I think, would benefit a lot of strengthening their efforts of financial literacy for the people to understand what are the advantages of the capital markets, both from the side of the firms, so that they can come and list, but also from the side of the investors that are the ones that will provide liquidity. So the more, for example, retail participation in the markets, the easier will be for SMEs to find investors buying their shares. And the last element that I would suggest is also, so one of the things that SMEs complain or feel in disadvantage is that they don't have research or analysis around those firms because they are small. So the investor may struggle to find research to understand what the firm is about and what are the conditions of the firm to make an informed decision. So providing this type of additional information will also be very helpful for stimulating these markets.
How should IPO market reforms connect to broader economic growth policy?
In general terms, I think that the first step is to clearly understand the benefits of capital markets for economic growth. So this is something that we cannot forget, that stimulating capital markets, increasing the number of IPOs is not a sector's agenda, but it is a need if we want a vibrating, growing economy. One of the recent research papers we published was precisely trying to understand what is to quantify the impact of a successful capital market in the economic growth. And there's a positive impact. Clearly, there are different channels. It allows, for example, small tech startups to obtain funding in a way that is efficient. It allows investors to place their money and save for their retirement. So there are many channels through which an active capital market will benefit the economy. Precisely understanding this will help the policymakers to take better decisions in terms of how to support the capital markets and bring investors to the markets, diminish the barriers for I mentioned before tax is an important element. So when we think about incentives for participants to come to the market, tax is one important barrier there.
Sustainable IPO activity depends fundamentally on stable pro-growth macroeconomic policies, because we found that the economic growth is one of the key, and uncertainty is one of the factors can shape the IPO the markets. So the firms are more likely to go public when they operate in environmental characterized by predictable growth and manageable inflation and more credible fiscal and monetary policy frameworks. So these conditions actually reduce uncertainty and support the investor confidence and improve firms' expectations about the future demand and profitability, which is telling us that actually the stable and pro-growth macro policy will help a lot.
Level playing field is important. So one of the reasons why firms don't want to go public is that they perceive that they will have less disclosure requirements and less regulatory burden if they go private. So private markets are not transparent, and therefore people do not know and do not need to disclose. The companies do not need to disclose their financial information. So that's for example not a level playing field, because clearly the level of disclosure is perceived as a disadvantage for a company that wants to go listing, and it shouldn't be like that. It should be a level playing field between private and public markets, which have a different function, a complementary function, but we shouldn't be, I think, providing incentives for firms to go private when we're talking about disclosure and requirements and reporting burden for the companies.